here to talk about today is rainbows and unicorns. What is at the end of the rainbow?
Gold.
Gold. A lot of gold, right? What is a unicorn? Well, in Silicon Valley, a unicorn is a startup company with over $1 billion valuation. Prosper Marketplace and the Lending Club are Silicon Valley unicorns. They offer peer-to-peer lending services. When the Lending Club went public in December, they raised $870 million and had a market capitalization of over $8 billion. That's not small, even among the giants of U.S. banking. So today I want to talk to you about what peer-to-peer lending is all about, why it has advantages, but also what the risks are if you engage in peer-to-peer lending, and how you might mitigate those risks, and where you can go to learn more about this investing opportunity. Small investors today do not have many options when it comes to finding a stable rate of return with a reasonable risk. Many view the stock market as the only game in town. How do you diversify away from the stock market if gold and real estate and savings and accounts and CDs and other things aren't providing either the proper risk, reward, other sorts of things? Well, an option to consider is peer-to-peer lending. I'm going to take an example, and you pick either the Lending Club or Prosper. I'll start with Prosper. The two offer nearly identical services. So what is peer-to-peer lending? Simply defined, the middleman, the bank, the credit union, is taken out of the equation and replaced by a marketplace platform and services that are provided by these peer-to-peer lending companies. So borrowers come in and apply for loans. Investors come in and buy up pieces of those loans. So here's what Prosper says they offer. A good rate of return for investors, the ability to diversify, the capability to build a portfolio that gives you a stream of income over time, and experience in managing credit risk by using their credit model to determine which borrowers are credit worthy and how credit worthy they are. This illustrates the cash flow. Borrowers come into Prosper. Prosper determines which ones are worthy of loans. Individual investors buy pieces of those loans. They build themselves a portfolio of various loans, and then as borrowers pay back the loans, that money flows into the investor's account. Of course, that's not all there is to lending. Different borrowers have different levels of credit worthiness. Now, the Lending Club and Prosper turn down 90% of applicants. They have thresholds in terms of FICO score, income, debt, and other things. They have sophisticated credit models that they apply to determine who's worthy, and they grade out and offer a percentage of interest rate to those borrowers based on how creditworthy they are. On the investor side, though, you care about what your return is after some borrowers default on their loan and other things. These are the average return rates at Prosper for different categories of loans. Interestingly, those most risky loans are the ones that investors most prize. And the greatest competition among investors is to get those high return loans. Now, the consumer might be paying 25 or 35% interest on that loan. But after people default on their loan, are slow to pay, or stop paying, the return to investors is still over 10%. So if you invest in just one of those risky loans, you'd be putting your money at risk. It'd be like gambling. But what you do is you buy a piece of dozens of loans, or ideally hundreds of loans. On Prosper, Everybody who owns 100 notes or more has had a positive return. On the lending club, about 0.7%, less than one person in 100 who owns over 100 notes, has lost principal, the money that they invested. So for example, if you invest $2,500 in 100 notes worth $25 each in terms of what the borrower borrowed, you can expect a positive return if future returns, future consumer behavior, future borrower behavior matches historical behavior. Here's an example from Prosper of the type of loans that are there. These are consumer loans, unsecured. That's why there's a high rate of return and a high risk. So why would borrowers come here versus going to the credit union or the bank? It's because they get a lower interest rate. Here you can see how fast this market's grown. It started back in 2006, 2007. The lending club is over $9 billion in value of loans made. And you can see the increase in the past few years has been especially dramatic. So let's talk about this issue of risk that you want to mitigate. So first I want to point out how popular the lending club is with investors. 5-star ratings and over 2,000 investments on Credit Karma, and pretty popular with borrowers and other users also. And it's because of these lower rates for consumers, but returns for the investors. And you can see that disparity there, so I want to make sure you understand the risk math. If your average portfolio is 11% return, 3% of those are charged off, and you pay a 1% fee to the lending club, your return is going to be 7%. If you have a properly diversified portfolio, you can get 5 to 10%. Some people get as much as 19%. But what do you diversify on? First and foremost, the number of loans held. Second, loan attributes. And third is borrower attributes. This is a process. The lending club or Prosper take a loan. They chop it into notes. These are securities. Security Exchange Commission is in charge of this. You buy one of those notes into a portfolio of hundreds. The more you diversify, the more likely you are to get a stable return. With over 400 notes, you can see most people at the lending club have been making 6 to 9%, 9 to 10, 12% range. Here are resources that you can go to learn more about this. Those are my prepared remarks, and now I'd like to take questions.
Mr. Speaker, is Prosper or lending company, are they private companies or public institutions?
The lending club went public in December. They had an IPO. Prosper is still a private company. They have not IPO'd yet.
Is there a section that lends to people in third world countries, say?
Yes, I personally participate on Kiva, which is a charitable organization that does micro-lending across the third world. It's a very similar model to this peer-to-peer lending model for profit. And I can tell you more about that if you're interested. Sir?
What do they have to do to stay in compliance with federal banking regulations?
The SEC has classified what they offer as securities. And so it's just like someone who offers a stock, a bond, or some other security. The notes that they offer are securities. In fact, there's a secondary market that you can buy those securities on if your state doesn't allow you to buy them. But they are heavily regulated by the SEC and are both well within compliance. Now, there were problems initially. People didn't know how to classify them, and the SEC in 2008 said, hey, we think you're a security. And that changed, that gave solid rules of the game for everybody.
What happens if a loan doesn't have all of its notes picked up by investors?
It isn't funded.
Oh.
Now what Prosper and Lending Club do is they have institutional investors who come in and some reserve themselves, so they will sometimes fund at 75% or 90% so to expedite the loan, knowing that people will buy those on the secondary market. But actually, there used to be more borrowers than lenders. Now there's actually more lenders competing for loans than borrowers.
Interesting.
Who is the board that's making the decision?
It's a credit risk model, mathematical model. Every lending institution has a mathematical model that scores, and they base it off of a whole host of information. The wonderful thing about peer-to-peer lending is they make transparent a whole host of information about each individual lender. So you can decide you're only gonna lend to people who are homeowners, or whose income is over $75,000, or whose FICO score is over 720, or whatever criteria you want to personally apply.
And how do you, second part of my question, how do you see that that's happening?
Through their website, and I can show you after the meeting if you're still interested. I'm out of time for questions, I'm sorry.
Thank you very much.